Good morning, guys. And again, this is your Prof. Zeus, and I'd like to welcome you to another session of financial accounting or intermediate accounting. Now, in the past sessions, we've discussed about property and equipment, the modes of acquiring property and equipment, right? So for this morning, we'll continue our discussion about acquiring fixed assets. How do we measure or initially value the assets acquired? Okay. So far we have discussed acquisition by purchase, by exchange, by issuing of the company's own shares or even bonds payable, and also we discussed about acquisition through construction. Okay, so for this morning we will be discussing about acquiring a fixed asset through donation. Okay, so when you speak of donation, someone is actually giving you an asset without you having to pay for it. Okay, that's actually donation. Okay, so when assets are donated to the company, we will value the asset at fair market value. Now, so debit asset, for example, there is a land that was donated to the company, so the answer would be a debit to your asset. Now, assuming it's a land, so debit land. Now, the credit would depend on who is the donor. Okay, is the donor a stockholder or a third party? Now, if the donor is a stockholder, then the credit would be to a donated capital. So that would be part of your shareholders' equity. Now, if the donor is a third party, say for example like the government, now how do you treat this? Now, it depends on the contract with the government. Is there a condition that has to be satisfied, okay, by the receiving party? Now, if this is the case, then you cannot recognize the asset as an income yet, okay, until you have fulfilled the requirement, okay, of the donor. Now, in which case you have to credit the unearned liability account, okay, unearned revenue from government grants. Now, this will be realized as revenue depending on the accomplishment of the project, okay, or the condition. Now, if there is no condition for the donation, then you can credit or you can recognize it at once as income. Now, let's have an example. The local government of Batangas has donated a piece of land to Victorious Liner on the condition that the bus company will construct a terminal where passengers can rest while waiting for their ride. The fair market value of the land at the time of donation is 10 million. The terminal was constructed for a price of 50 million and can be used for 20 years. Now, so the donor here is the government. Now, is there a condition? Yes, there is a condition. The condition is that they will have to construct a structure, okay, a terminal where the passengers can actually wait and you can wait comfortably, while waiting for their ride. Okay, and so therefore, with this type of problem, we can say that we cannot recognize the asset as a revenue yet because there's a condition that needs to be satisfied first. Okay, so what are we going to do here? As I mentioned earlier, we can recognize it first as a what? As a liability. Okay, and then we recognize the structure as another asset of the company. And then while we depreciate the structure, that's the time that we also recognize the income from the donated asset, okay? Or the income as donated as income, okay? Sorry. Now, let's solve this problem. Okay? Dito naman tayo sa whiteboard. Sorry for this arrangement, guys, no? Okay. So let us try to solve. Okay, so how are we going to solve this problem? So first, let's do the entries, okay? So number one, for the donation, so debit land, at fair value of 10 million, right? Okay, 10 million pesos. And then credit your unearned revenue from government grants, for 10 million pesos. Okay? So as you can see, we recognize it first as a liability. Why? Because we still need to meet the conditions set by the local government or the donor, okay, before we can gradually recognize it as an income. Okay? So therefore, the condition is for them to construct a terminal, and they constructed the terminal, so therefore we will record the terminal building and then cash or accounts payable, whatever is appropriate. This is for 50 million pesos. Okay. Okay, so we have already fulfilled the obligation or the condition, which is the construction of a terminal. Okay, so we can now, since they are using the terminal, then what are we going to do? We then depreciate the terminal. So the depreciation of the terminal, debit your depreciation expense, and then credit your accumulated depreciation. Okay, and how are we going to compute for this? This will be 50 million divided by 20 years. How much is that? Okay, that's 2.5 million. So this is 2,500,000. Now, note that we have already started using the terminal. So therefore, okay, we can now recognize the unearned revenue as earned revenue, but that will be amortized over the life of the terminal. Okay, so we will use the same basis as what we use for the depreciation of the terminal. So therefore, okay, let's have it here. So how much will that be? So that's essentially 10 million divided by 20. So that would be 500,000, right? 10 million divided by, that's 500,000. So this is the amount of income that we will recognize every year. So what would be the entry? Debit your unearned revenue okay, from government grants, and credit your revenue. So this is 500,000 and this is 500,000 as well. Okay, so as you can see, we are now matching. Okay, we are matching the revenue with the cost, which is the depreciation. So gradually we're recognizing both revenue and of course the expense. Okay, so this is for the donated asset. Now what if the donation is in the form of cash and there is no restriction or condition? Then we can recognize it as income immediately. So debit your cash and credit your income or revenue from government grants. Okay, now let's go to the next one. Okay, so we have discussed the different modes of acquiring fixed asset. Okay, now of course, as assets are being used by the company, the value of the asset eventually decreases or diminishes. No, now this is because of the usage and of course the passage of time, the mere exposure to the elements in the air, the sun. Okay, so your asset values eventually decreases, and this is actually recognized in accounting through what we call depreciation. Okay, so in accounting, what we do is we allocate the cost of the asset over the estimated useful life. Now, I'd like to point your attention to the fact that it is what an estimated useful life. Okay, as such, can estimates change? Of course, because we cannot say that your estimate is 100% accurate. So please have an open mind, okay, with regard to this estimates. Okay, so later on we'll discuss about what if the estimates actually change over time. Okay, what are we going to do with that? Okay, so there are many modes of depreciation or depreciating an asset, but remember this, guys, your choice of depreciation method should parallel the pattern of benefits that you receive from the asset. So say for example, you are receiving equally the same benefit from the asset, like you are renting a house, so therefore the benefit that you receive from day one up to the last day of your lease is essentially the same, right? So therefore you have to use the straight line method. No, so you have to check on the pattern of benefit, okay, that the company receives from the use of the asset. Is it the same from day one to the last day or not? Okay, so here are the different methods of depreciating an asset. We have the time factor methods, that includes straight line, and of course accelerated methods like sum of the year's digits, double declining, 150% declining balance, and of course the declining balance method. And also we have activity or use factor. We have the service hours and then the productive output method. And for multiple assets, we have the group method and the composite method. Okay, so let's have an example. On January 1, 2019, AEG Corp purchased an equipment costing 1 million. The asset an estimated useful life of 5 years. Okay, the asset was used productively for 4,000 hours in 2019 and 4,200 hours in 2020, producing 3,200 units in 2019 and 6,800 units in 2020. Total estimated productive hours and total estimated units of production are 20,000 hours and 30,000 units respectively. So with this single example, okay, we will compute for the depreciation using the methods I have discussed earlier. Okay, so again, let's go back to this whiteboard. Okay, so let us now compute for the depreciation of the asset using different methods that I have discussed earlier. Okay, now for the straight line method, we will use the formula cost less residual value divided by the estimated useful life. Now, what is residual value? Residual value is also called the hold on. Okay. Let me just adjust. Okay, so for the straight line, so the formula is cost less residual value divided by the estimated useful life. Okay. Now, what is residual value? That is that is also called the salvage value. No? So that is the value of the asset, okay, that can be recovered, okay, through sale, through a sale transaction. Okay, normally this is the value of the asset at the end of its estimated useful life. Okay, let us now solve. So therefore, the cost of the equipment is 1 million. 1 million pesos. There is no salvage value divided by the estimated useful life of how many is that? 5 years. Divided by 5 years. So therefore, this is 200,000 pesos per annum. So remember, this is per year because we express this in terms of years. Okay, so this is the answer for the straight line. Now, the second one is the sum of the year's digit. Now, what do we mean by sum of the years? When you say sum, then you just have to add. Okay, so there's a formula actually. You have n, the number of years, n plus 1 divided by 2. So in this case, this will be 5 times 5 plus 1 divided by 2. So therefore, this is 5 times 3, this is 15. Now, what if you forget about this formula? Okay, during the examination, you forget about the formula that, Professor Zeus taught you. So just remember, it's sum of the years. So what are you going to do as an alternative? You just add them all up. 5 plus 4 plus 3 plus 2 plus 1. So this is 15. Okay, now this is an accelerated method. What do we mean by accelerated method? We expect to produce higher depreciation charges during the first few years of the lives of the asset. Why is this? Because we feel that we are receiving more benefit during the first few lives of the asset rather than the latter part of the life of the asset. Okay? So therefore, how are we going to compute for this one? So for the first year, say this is 2019, your numerator will be the number of years. So that's going to be 5 years divided by the denominator will be this one. 15 times 1 million. Now, this is actually the depreciable cost. So if there is a salvage value or recoverable value, or residual value, you have to deduct the residual value from here. Okay? So let us try. So therefore, that's 5 million divided by 15. Okay, so this will be your depreciation for every year. 333 333. So using the sum of the year's digit, your first year depreciation shall be 333,333. What about the second year? So for 2020, this would be 4 over 15 multiplied by how much? 1 million pesos. So therefore, how much is that? So that would be 1 million times 4 divided by 15. So that would be 266,667, and so on and so forth. Okay? So this is the sum of the year's digits. Okay? Then we'll go to the next one, which is the declining balance. Now remember this, guys. Only in declining balance method that we are not going to use the salvage value or the residual value of the asset. So we'll be using the cost, because at the end of the useful life, the balance of the equipment would be the salvage value of the equipment. Okay? So how are we going to do this? So the asset life is 5 years, so therefore 100% is the useful life of the asset divided by 5. So the depreciation rate is 20%, right? So therefore, on the first year, 2019, that would be 1 million pesos depreciation, no? Times 20%. So this is 200,000. Okay, so therefore, the balance of this equipment at the end of the first year will be how much? So the carrying value would be, that would be 1 million minus 200. That's going to be 800,000. Okay, how about for 2020? So 2020 now, that will be based on the new carrying value of the asset. So that will be 800,000 times 20% is equal to 160,000. Okay? So therefore, 800,000 minus 160,000, this would be equal to 640,000. Okay? So just continue with this until you reach the end of the useful life of the asset. Okay? So that is the declining balance. Now we have the double declining. When you speak of double declining, essentially, it is just 200% of the rate. So therefore, here, we multiply this by 2, so therefore this is 40%. So we're just going to change this from 20 to 40. So this would be 400,000, and this would be 600. Okay, so this would be 400,000 times 40. Okay, so therefore this is 4 times 4, this is 160. Oh, what a coincidence. So therefore, 400 minus 160, that would give you, how much is that? 240, 340, 240. Okay, so therefore, you just continue again until you reach the end of the useful life of the asset. Now, the other one is 150. You just have to multiply this by 150%. Okay? So let us now go to the other one, the output method. Okay? So therefore, we have the, what's the output method again? Service hours and productive. Okay, service hours meaning you just have to divide, okay, you just have to compute for the depreciation per service hour. The other one, depreciation per productive output method. Okay? So therefore, let's have the service hours. So again, that's going to be cost less residual value divided by the estimated service hours. Okay, so therefore the cost is 1 million without any recoverable value divided by how many is the total service hours there? Oops. Okay, total service hours is 20,000 hours. So divided by 20,000 hours. So therefore, how much would be our depreciation per service hour? Okay, divided by 20. This will give us 50. Am I right? So 1 million divided by 20,000 service hours. Oh, that's 500. Yeah. Divided by 20,000. That's 50. Ayan. Okay. Ulitin natin, baka mag-iba na naman. Divided by 20,000. Okay, that's 50 pesos per hours. So we multiply this by the number of hours used. Okay, how many number of hours were used? 4,000 and 4,000 and 4,200. Okay, 4,000. Okay, so multiply this by 4,000 hours. Sorry, 4,000. So therefore, 50 times 4,000 hours. This will give us a depreciation of 200 pesos for 200,000, sorry, for 2019. How about for 2020? Just have to multiply this by the number of hours that were used, okay, which is 4,200. So for the following year, that's going to be 4,200. Okay, that's going to be 210,000 pesos. That will be the depreciation charge for 2020, okay? How about for the estimated production? So again, we just have to replace the denominator with estimated production. So estimated production. So therefore, how much will be is expected production? 30,000 units. Okay, so divide this by 30,000 units. And so therefore, our depreciation per unit of output will be, that's 1 million divided by 30,000. That would be 33.33. So this is our depreciation per per unit of output, production output. Okay, so for you to get the depreciation, you just have to multiply that with the number of units produced. So that would be how many units? Producing 3,200 units. So times 3,200. So therefore, that's 33.33 times 3,200. That would be 106,656. Okay? So there you go for the depreciation using the output method. Okay? Now, we also have what we call the component depreciation. Okay? Now, as the term implies, component. Okay? So, this type of depreciation allows management to make an estimated useful life for each of the significant components or parts of an equipment. Okay? So, therefore, the depreciation shall be based on the part of the equipment's estimated useful life. Now, what do you see on the screen? So that is an Airbus 380. Okay. Now, before, you just have to depreciate the whole of it. Okay, using one estimated useful life. But with this composite depreciation method, management can now depreciate this one aircraft into different number of years. Okay, depending on the identified significant parts. So therefore, management has to identify what are the significant parts of this aircraft and of course make an estimate of the useful life for those significant parts. Now let us just assume that these are the significant parts of the aircraft. So assuming engine has a 20-year life and the cost is 40 million, the wings has a 10-year life and the cost is 10 million. The seats has 10-year life, 10 years of estimated useful life, and the cost is 5 million. And the others, meaning all the other parts of the aircraft, that's 5 million pesos that can be used for another 5 years. Okay, so therefore, we are going to depreciate each significant component or each component of the aircraft. So those that are significant will have to be identified separately by management. Okay, so like in this case. So engines, 40 million divided by 20, so the depreciation per year is 2 million. Now the wings, 10 million divided by 10 years, so the depreciation is 1 million. And then the seats, 5 million divided by 10, so that's 500,000. And the other parts would be 5 million, that's depreciable for 5 years or 1 million pesos. So the total depreciation for the aircraft is how much? So 2 plus 1 is 3 plus another 1 is 4. So plus 500, that's 4.5 million. That is component depreciation. Okay? Now, let's go to the next one. Now, as I mentioned earlier, the estimated useful life of an asset, no, is just an estimate, and so therefore that can change over time. Okay, that can change over time, probably because management, has made some improvements, or just hold on, just really, it's subject to change. Okay, estimates are really subject to change. Okay, so as we move along, as time passes by, estimates may prove to be wrong. Say for example, you have depreciated your car for like 5 years, but after 5 years, is your car already worn out? No, you can still drive it for the next 15 years. Okay, so it's okay to have changes in terms of estimates. Okay, so what are we going to do with the changes or what are the changes or estimates made by the company with regard to property and equipment? The estimated useful life, the estimated salvage value is an estimate, and of course, before this used to be a change in policy, but now it's already a change in estimate, and that is the use of the depreciation, the choice of the depreciation method. Okay, so if the company, for example, changes the depreciation method from straight line to SYD or vice versa, that should be treated as change in estimate. Okay, so the question now is, how are we going to account for this changes in estimates? Okay, so we are going to account for it, we are going to account for it currently, and of course, since it will affect the future periods prospectively. Let's have an example. Steps. So when there's a change in accounting estimates, what are we going to do? First, compute the remaining depreciable cost of the asset. Okay, say for example, the asset was purchased 2019 and management has made a change in 2020. So compute for the depreciable life or depreciable cost as of the date of change. If that is January 1, then January 1, 2020. So there's already an accumulated depreciation for 1 year. Okay? Now, divide your remaining depreciable cost with the remaining useful life. Now, this remaining useful life can be very tricky because of how it's given in the exam. The exam can give you the total life since the purchase, in which case you have to deduct the expired or the used portion. Okay, it can also give you the remaining useful life, and you have no problem with that. Okay, and then the resulting figure shall be the revised depreciation. Okay, let's have an example. So on January 1, a machine was purchased for 5 million that can be used for 5 years. Depreciation using the SL or the straight line method is used. Okay, so therefore let us now compute for the depreciation for 2019. Let's go back to this drawing white table. Whiteboard. Okay, so therefore, okay, so the depreciation now is cost, that's 5 million pesos. There is no salvage value divided by the estimated useful life of 5 years. So therefore, this is 1 million pesos. So this is now your depreciation. What is the entry? Debit depreciation expense, credit accumulated depreciation for 1 million, right? Okay, so what happens is that, so this is the answer number 1 million pesos, okay? Now, the next one, at the start of 2020, let me just read it for you. At the start of 2020, management has estimated that the remaining useful life of the machine is 5 years. Okay, so in total now of the estimated useful life is not 5 years, but rather 10 years. Okay, let me just turn this off. I'm sorry. Okay, so you can see now that the estimated useful life is not really 5, but rather 6. There's the remaining 5 years, but 1 year has already expired. So therefore, the total is 6. So therefore, what are we going to do? Let us compute for the remaining depreciable cost. That will be 5 million, the cost, less the 1 million depreciation. So therefore, the remaining depreciable cost is 4 million pesos. So 4 million divided by estimate the remaining life of 5 years. So this will become 800,000 pesos. So this is now the depreciation for 2020. 20. Okay? Hope you get that. Now let's have another one. Okay. So let's have another one. Okay, so on January, can you see the problem, guys? Okay, there. So on January 1, 2019, a machine was purchased for 5 million that can be used for 5 years. Depreciation using the SYD is used. Okay? So the question is the depreciation for 2019. In 2020, management has decided to change the depreciation method to straight line. So as I said, you have to account for this currently and prospectively. Okay, so how are we going to do this? If you would notice, so we compute for the depreciation of the machine on the first year. Okay, so using the SYD, that will be 5 over 15 times 5 million. You have 2,083,333. Now, 2020, there was a change from SYD to straight line. So therefore, the remaining depreciable cost is actually 5 million minus the accumulated depreciation of 2,083,000. Okay, so therefore the remaining depreciable cost is 2,916,667. Now there was no mention of the change in estimated useful life, so we will assume that it's still the same, 5 years. So 1 year has lapsed, so therefore the remaining life is 4 years. So therefore we divide the remaining depreciable cost by the remaining useful life, and we will have 729,167 as our depreciation for 2020. Okay? So that is our example for changes in estimates. So there you go. Those are the answers. Okay? Okay, now let's go to accounting for natural resources, or what we call wasting assets. Okay? So this would be like, the mining industry, applicable for mining industry, for extractive extracting resources. Okay. Now, of course, first question is what is the composition of the cost of the natural resources? Now, the cost would include the purchase price, exploration costs, development costs, and of course the present value of any restoration cost. Because of course, every LGU would like the property to be restored. Okay. So say for example, a mining company has brought the mining right over a certain island or a certain mountain. They will really dig into the mountains. Okay, therefore the integrity of the soil could be compromised. So that could cause a lot of problem for the LGU. Okay, once that happens, so therefore they may require the company doing the mining to somehow restore it to its usable form. Okay. So that it can still be of use for the LGU and its constituents. Okay, so therefore that is natural resources. Now, when the natural resources has been extracted, okay, although there's a value still, what are we going to do? Instead of depreciating the natural resources, what we're going to do is to compute for the depletion of the natural resources. Now, if you would notice, the depletion is actually using the productive output method. Okay, so it's the number of units that you produce that is used for depleting the natural resources. Okay, so we compute for the depletion rate per unit of output. Okay, so if there is a useful or the salvage value, then you have to deduct the salvage value of the wasting asset or natural resource. Okay, that would be your depletable cost. Okay, so let's have an example. Let's have an example. Assuming that on January 1, okay, the company purchased the mining right for about, say, 100 million. Okay, let us assume that this is already inclusive of whatever cost components that we have discussed earlier, okay, such as developmental cost, okay, and of course the restoration cost. Okay, now the expected production is, say for instance, 100 million 100 million ounces of gold. So this is the number of, or estimated number of units that can be extracted from the mining site. Okay, so what are we going to do? We have to compute for the depletion. So the depletion is what? That's going to be 1 million pesos, the cost, divided by 100 million units of output. Okay, so therefore this is 1 peso per unit of output. So again, what are we going to do to find for the depletion? We just have to multiply this 1 peso per unit of output by the number of outputs, okay, for each of the year. Say for example, they have like 1 million output. So the depletion would be 1 million pesos for the first year. So this would be the depletion. Okay, now that is actually not one of the issues, because this is easy, not one of the issues, because this is really very easy to compute. Now, one issue there is, of course, in a mining company, you need what? You need equipments to dig into the mountains and all the stuff, right? So the question is, how are you going to depreciate? Because the mining rights, you are going to deplete, but what about the equipment that you use, okay, for the mining operation? Say for example, the tractor like this one. Okay, let us pretend that this is the tractor, whatever that is, okay? Okay, so assuming that this is your tractor, what about this equipment that was used in the mining operations? How are you going to depreciate this? Are you going to depreciate this using the straight line method, or are you going to depreciate this using the unit of output method? Okay, so remember this, guys. First, you have to check which is longer. Is it the estimated useful life of the equipment, or the estimated useful life of the mine, or the mining rights, Okay, let us assume that the estimated useful life of the equipment is like 10 years. But based on estimates, the estimated useful life is 5 years. So as you can see, the estimated useful life of the mining right is lower or shorter than the estimated useful life of the asset. Now, if there is no other use for this asset, then we have to depreciate this using since this is shorter, then whatever depreciation method that we use here will be the one that we have to use in depreciating the equipment. Okay, so let us have an example. So for instance, the company bought a tractor worth 1 million pesos. So divide this by 100 million. So how much will this be? So 1 million divided by 100 million. So this will be 0.01. So if there's a production of 1 million, so how much is the depreciation? Times 1 million. So that would be 10,000 pesos for year 1. So this will be your depreciation, and this will be your depletion. Okay? Now, mining is a very, I would say, not a very stable business. No, it's a hit or miss. So what if on the first year there's what? Extracting activities, but on the second year there was none. So they shut down the operations totally. So what will happen is that, what happens with the depletion? What happens with the depreciation? For depletion, of course, you don't have a choice. Remember the formula. We have to multiply this 1 peso by the number of units. But if this is 0, then depletion would be 0. Right? But what about the depreciation? So for depreciation, again, the exposure of the asset to the elements, of course, that somehow affects the status of the equipment. So therefore, you still need to depreciate. But how are we going to depreciate if this is also 0? You have to shift to the straight line. Okay? You have to shift to the straight line, and when the operation returns, then you go back to the output method. Okay? So that's it for today, guys. Please answer the exercises in the book. Okay, we'll be discussing them next meeting. Okay, so this is again your Prof. Zeus, and I hope you enjoyed the session this morning as much as I did. Bye, and please stay safe, and then I'll see you again in our next session. Okay, thank you very much. Bye.